Hello everyone, welcome to this session. In this session, we will apply the concepts whatever we learned in the previous sessions about financial crisis. We apply all that framework to understand the sequence of events in the Great Depression of 1929 and 2007-8 crisis. So, especially in particular, we will be looking at this one from an economic angle, what led to, what caused this financial crisis, and then we will see that again we will put it in this, apply this sequence of events in our framework. So, the first one, the Great Depression of 1929-30, which lasted for 1 decade, and this one is considered as the mother of all financial crises. And importantly, our question here is, how did a financial crisis unfold during the Great Depression and how it led to worst economic downturn in US history? And this event was brought on by the stock market boom in the beginning. In the beginning, there was a stock market that in 1928 and 29 there was stock market boom in 1928 and 29. The stock prices doubled in the US market in these years. The Federal Reserve officials viewed the stock market boom as caused by excessive speculations. So, in order to curb it, they pursued a tightening of monetary policy to raise interest rates in an effort to limit the rise in stock prices. As we have seen in one of the previous session, when the rate of interest declined, you know that when the rate of interest declined, especially in the session in setting the prices of stocks, we have seen that when the monetary policy reduces the rate of interest, stock prices increases. So, when the Federal Reserve, the central bank, realized that the stock prices, there is a boom almost double, and it is because of speculation, what they did that in order to reduce the stock price, because they understood that it's a speculation, that the stock price is not really reflecting the economic fundamentals, instead it's a speculation, they tried to the tight monetary policy increased the rate of interest, and as a result the stock price declined further. There is a decline in stock price later on. So, but the Fed got more than it expected. Therefore, when the stock market crashed in October 1929 by falling by 40% by the end of 1929. So, that means there is a because of this tight monetary policy, it led to one of the biggest crash in the stock price in the US. Further, in order to add to this, there are some other related aspects also happened in the US. One of them was that actually there was many defaults on farm mortgages. In parallel to the stock market crash, a bank panic also emerged in the US. Especially in the agriculture sector, there was defaults on farm mortgages, which led to large loan losses on bank balance sheet in agricultural regions. So, it prompted substantial withdrawals from banks and building into a full-fledged panic in November and December of 1930, with the stock market falling sharply. So, two things we can see: when the stock market fell as a result of the tightening monetary policy, the net worth of many firms declined. It affected their ability to repay their loans. That is one, and many banks they experienced default risk. And in addition, the farm mortgage, there was default on farm mortgage as well. So, then by 1933, more than 1/3 of the US commercial banks had failed. So, that means the banking crisis happened by 1933, by 1/3 of the US commercial banks failed. That means a full-fledged banking crisis erupted. So, you can see the stock price in 1929, that means the peak of the stock price. Then because of the tight monetary policy, then you can see that it crashed, that is huge crash, sharp decline in the stock market price. So, as further this led to this is actually the asset market component, that the asset price effect, that is the stock market crash. Then as we seen in the figure, the diagram that we discussed in the previous session, is that it led to the banking crisis. continued decline in stock prices. By mid 1932, stock had declined to 10% of their value, and there is increase in uncertainty from the unsettled business conditions created by economic contraction, which worsened the adverse selection and moral hazard problems in financial markets. A manifestation of the rise in financial friction is that lenders began charging businesses much higher interest rates to protect themselves from credit losses. That means there are only a few lenders in the market, and because of the financial friction, those who are in the market, they started charging high interest rate to protect themselves from credit losses. So the resulting rise in the credit spread, that is the difference between the interest rate on loans to households and businesses and the interest rate on completely safe asset, that the US Treasury securities, that increase. That means that there is increase in credit spread that happened in the US. So coming to the credit spread, this is the credit spread during the Great Depression, that the uncertainty in financial market increased the spread between the corporate bonds and low risk treasury bonds. So this is the credit spread that actually increased further and further during this period. So you can see that increase in the spread. So that means it became expensive for the borrowers to borrow because the interest rates for private firms that actually increased. So you can see that because of this, it led to decline in economic activity, which that means it further led to debt deflation. That means declining economic activity eventually led to a 25% decline in price level. So we expect a moderate inflation, but you can see because of this economy experienced a 25% decline in the price level, and since it was an unanticipated one, the huge decline in price triggered a debt deflation in which net worth fell because of the increased burden of indebtedness borne by firms and households. So the decline in net worth and the resulting increase in adverse selection and moral hazard problems in the credit market led to prolonged economic contraction in which there is sharp decline in GDP and unemployment rose to 25% of the labor force. So here we can see that because of the series of events, finally the financial crisis led to the economic recessions, where we can see that the unemployment rose to 25%. So after this, let's now apply the framework in understanding 2007-8 financial crisis. About the 2007-2009 crisis, what we can see that in 2007 we are going to see that it was mostly a subprime, a mortgage crisis. Then in 2008 it became a financial crisis, and in 2009 it became an economic crisis. About the causes of 2007 and 2009, overall there is actually a debate on what caused the 2007-8 crisis. However, most of the arguments were in favor of that the financial innovation in the mortgage market is one of the reasons. The financial innovation that it led to financial engineering, the development of new sophisticated financial instruments led to structured credit products in the financial markets. So this actually created, because of the new products in the market, many people are not able to, even the investors are not able to properly understand the actual economic fundamentals behind these financial products. Then see lots of new products coming in the market, but that will actually as an outcome of financial engineering, and then actually most of these products didn't truly reflect its economic fundamentals. In addition, we also see that there are so many agency problems in the mortgage markets, because mortgage brokers who originated the mortgage loans often didn't make a strong effort to evaluate whether the borrower could pay off the mortgage, since they planned to quickly sell the loans to investors in the form of mortgage backed securities. So some kind of agency problems happen here. They couldn't clearly check the default risk the ability to pay back of the mortgage by the borrower. That also they couldn't look into. In addition, we can also see that there was asymmetric information problems in the market. Credit rating agencies who rate the quality or debt securities in terms of the probability of default were another contributor to the asymmetric information in the financial markets. So, we will see that the rating agencies actually advise clients on how to structure complex financial instruments in the market, and at the same time what they also did that while at the same time they were rating these identical products. That means they helped as the conflict of interest that we have seen in the previous session. They advised them to they were the consultant for them, and they developed their products. At the same time they actually rated the same products as well. So, that is conflict of interest because of the large fee they earn from advising clients on how to structure products, and at the same time the income that they are earning from rating as well. So, all this led to the financial crisis. So, in stage 1 what we can see that actually the causes of 2007-8-9 financial crisis, so mainly it is because the financial innovations emerging in the mortgage market. This actually in the first phase which we have seen that the asset price effect, here actually the asset price effect happened. It was led by subprime mortgage and mortgage backed securities and collateralized debt obligations contributed to the first stage of financial crisis. So, what is subprime mortgage means? So, subprime mortgage means lending giving housing loans, that the housing loans to high risk, otherwise who is normally loans will be given to prime borrowers, but subprime borrowers means those in otherwise they are unable to pay back, but because of the financial innovation and some of the economic and political developments in the US system that promoted subprime mortgage. Then because of the financial innovation, these mortgages were further developed into new financial products called mortgage backed securities, and then these one further developed into CDOs. So, this is the historical development here is that increase in liquidity from cash flow surging into the United States happened in 2000, after 2001, when the economy was in near a recession, and when the economy bounced back there was increase in liquidity from cash flows. Then as a result the development of subprime mortgage markets fuel housing demand and housing prices. We can see that the housing price, because of the increase in demand for housing, at the same time more liquidity with the banking system, the housing price market, there was a peak in the housing price in 2006, at the end of 2006. This in again there was increase in stock market price as well, stock market peak in 2007-8, in the beginning of 2007, and let us see what it led actually, what is the historical background. So, the historical background here is there is residential housing prices boom and burst. The boom happened because the subprime mortgage market took off after the recession ended in 2001. So, by 2007 it had become over $1 trillion market. The development of subprime mortgage market was encouraged by economists and politicians alike, because it led to democratization of credit and helped raise US home ownership rates to the highest levels in history. From an equity perspective, fairness perspective, everyone supported, that means the encouraging that the lending to the subprime customers as well, subprime borrowers as well. That means otherwise they are not eligible. Based on the normal market condition, many people won't be eligible to get loans because of they don't have much collateral. Their high mortgage, that default risk is very high. So, but because of the development happened in 2001, after that, because there is an increase in liquidity in the market, and then as a result there is overall support in favor of increasing the housing ownership. So, even government involvement was also there in the housing market through Fannie Mae and Freddie Mac. So you can see that the reason is that actually the Federal Reserve, having anticipated a mild recession that began in 2001, reduced federal funds rate 11 times between May 2000 and December 2001. That means it was to 6.5 in 2000, then it became 1.75% by the end of 2001. That means significant decrease in the interest rate in the market. Significant decrease in the interest rate enabled banks to extend consumer credit to a lower prime rate. That means interest rate that banks charge to their prime or low risk customers generally 3% above the federal funds rate, right. And then normally what they did that since the rate of interest declined considerably in the market, they already lend to, normally what they lend to their prime customers, they lend above 3% above the federal funds rate, and still they have more, then also they have more cash with them, liquidity there. So then they encourage them to lend even to subprime or high risk customers, though at a higher interest rate, because market interest rate is very low. So they even charge a little bit higher interest rate than the prime customers. Then they extended the loans, the housing loans, especially to subprime customers as well. Then actually the US market, actually the mortgages and mortgage backed securities, this will become a prominent feature in 2006, 5, 6, 7 period. The mortgage means the collateralized loans where the house that borrowers are going to buy act as collateral. And then there was a securitization as well. That means financial innovation or financial engineering. That is, the securitization is the financial practice of pooling various types of contractual debt such as residential mortgages, commercial mortgages, and selling their related cash flow to third party investors as securities. That means generating new financial products out of mortgages, residential mortgages. So these mortgage-backed securities were an attractive investment opportunity for many investors, because for them it looks like a very new product, a completely new product. They are not really knowing what are the houses or what are the securities behind it, that collaterals behind it. Instead of they are finding it's a new product and they are offering high expected returns and seemingly less risky and very liquid. That means what we can see here is that the collateral loan, the mortgage loans are converted into a new product, new financial products, and that was often traded in the market. So banks could make profit from this transaction, and then banks also could transfer their risk, because the loans payment, the cash flow from these loans will be handed into third party investors, right. It is handed into another firms, and it will be further sold out to new investors. So then further this MBS, that the mortgage backed securities, even if out of them which is the high risk component, that means where the cash flow is low from those MBS, mortgage backed securities, the high risk one where the cash flow is less, that even further divided into developed into a further product, new product called collateralized debt obligation. So the cash flow generating from assets are pooled to form new tranches, so sold to different investors again, that also contributed. So let us see what is this collateralized debt obligation, how it was developed. By seeing this figure, you will get an idea. Here what they did, that these are all the housing loans, mortgage loans to individual borrowers. All these were made into a new financial products called pool of mortgage loans because of the financial innovation, and this has been rated as AAA, that means low default risk. That means the flow which is coming from, because there are many borrowers who is making no default, who suppose these many borrowers are not making any default, they are repaying their EMI on time, repaying their loan every month on the scheduled date, then that one will be categorized as, because within this whoever is repaying, that will be categorized as AA. Those who is owning this one, buying this one, because in the of all this pool whichever is whoever is making payment, it will be given to this whoever is buying AAA products from this. This pool itself, mortgage loans, it is characterized into a different category, that is one product is this, another is this like this. So when there is a pool of fund coming, this will be first given when the flow coming, it will be first given to these people, those who are owning AAA products. For them the rate of interest will be low rate of interest will be given to them, and then if there is no default, because here the default risk is high, right. So here if they are paying back, then these people will be getting, but here they will be getting high interest income if they are paying, that is the condition here. Then further what it happened that though among the this group, that means who are the high risk tranche, it was further out of this it was made into for new products called CDOs. This again, see, look at here the point again, within the mortgage loans whoever is, that is the high risk, this high risk is further characterized into made into a new financial products called CDO. This again have further within that again there is highly rated and low rated products, CDOs again. So here actually you can see that this is even, if here the risk will be very high, these people, but they will be getting high expected return, but actually during financial crisis 2007-8, actually what happened that those who are owned this one CDOs, they didn't get back their return, and the banks who gave these loans began to suffer. So this is the overall another illustration of this one, that is the CDOs. This is from the low rated component of the RMBS is transformed into CDOs. Then from this is converted into CDOs. CDOs that the pool, the CDO manager and securities firm pool various assets in an attempt to get diversification benefits, and this one further made into AAA, AA kind of products. So that means CDO tranches have been made. So this is the full illustration of this one, the theory of how the financial system created AAA rated asset out of subprime mortgage. Actually this AAA rated, that means you know the low default risk, right, high quality asset, this has been generated out of subprime mortgages. So in the financial system the AAA rated assets are the most valuable because they are the safest for investors and the easiest to sell, and financial institution packaged and repackaged. First they packaged into residential mortgage pay securities, that is residential backed mortgage securities. First they made it like that, then they further repackaged it into CDOs, that is further they did it. So repackaged securities built on high risk subprime mortgages to create AAA rated assets. The system worked as long as the mortgages will all over the country and of all different characteristics didn't default at once, all at once. That means what we can see that initially there is housing prices boom because of the increased demand for houses. You can see that initially there is a mortgage boom in the country, mortgage boom, but that was the boom, obviously you know that it has to burst over time. So in the short run you can see that there was increase in the stock price. Those whoever bought this house and also whoever bought these securities, they all started benefiting in the beginning. So what we can see that people all over the country take out mortgages, financial institutions group hundreds of subprime mortgages into mortgage based securities. That is first stage, first start. Then the securities are grouped into tranches by levels of risk and earning potential for bondholders. When everybody can pay their mortgages in full each month, each group of bonds holders get paid, right. That is in the initial phase. Then let us see, this is the initial phase of mortgage boom. Then the mortgage payments are collected by a financial institution and payments distributed to bondholders. So higher rated tranches are paid first. When when monthly mortgage payments are not made, payments may not reach holders of lower rated tranches. So, this is the initial situation. So, in this case, let us look at this figure how things move on further. So, this part you can see that this one is residential mortgage payments, that means these are the individual borrowers, owners of borrowers of a mortgage borrowers. So, we can see here is that this tranches this has been grouped into a group of borrowers. Suppose this one is group made into one RMBS group, one group, another group of borrowers have been grouped into another group, another resident mortgage backed securities, then this one is made into the another group, and then here you can see like that. But see, here is a red color, that means default risk is very high. Here also default risk is very high. That means different groups of residential mortgage based on their payment, they were made into different RMBS. In that way, different RMBS has been created, and then the payments from this one, because it has been made into different products, that the payments from this RMBS has been made into different groups, that you can see that AAA, AA, A, BB, BB minus, and unrated, like that. Let us continue this discussion in the next session. So, because we need some more aspects to discuss in this 2007-8 crisis, we will continue this discussion in the next session, and see you in the next session, and thank you.